welcome back to my channel. In today's video I'm going to talk about one part of buying a house that I think a lot of people don't think about. When most people think of buying a house, all they think of is essentially the price of the house. So, you know, does this house cost $200,000 or $300,000 or whatever? But the thing that they are missing is how much is the interest rate, because this can have a very dramatic impact on how much you actually pay towards your mortgage each month. So for example, if you got a $250,000 house and you put down a $50,000 down payment so you don't have any PMI, then with an average credit score today, you would get around 5.5% to 6% interest on your loan. And this would lead to your housing expenses payments in between your mortgage, your taxes, and your house insurance to add up to around $1,500. However, just 6 months ago, when the interest rate for the same person would be about 3%, their total payment would only be about $1,176. So this is about a $350 difference per month. So, I mean, at least for me personally, this would mean I would have to buy a completely different house just based on this interest rate. And to look at it through another lens, the payment that you'd pay each month for a $250,000 house at the beginning of this year is roughly the same as what you would pay for a $200,000 house today. So even if housing prices do go down a little bit, you're still going to be paying the same amount of money, unfortunately. And as you can tell by this chart, over the past 6 months or so, the interest rates have really skyrocketed, and this is because the feds are raising the interest rates to combat inflation. So one of the easy places we can see this effect is with the mortgage rates. If you've made it this far into the video, please consider subscribing to my channel for more videos and leave a like if you have liked the video. But back to the video. So finding out about how big of a difference the interest rate can have kind of led me to doing some more research into how the credit score is used for the mortgage and so on. So first of all, there are 3 different major credit bureaus, and each one of them gives you a slightly different score for your credit history. This is why if you look at your credit score in one place and then another, it could be a decent variation in credit score. For example, it could be, let's say, 700 in one and 720 in the other, which is enough to make a difference on a loan. So which score would the bank choose to look at when giving you a mortgage? And the answer to this is they would pick the score that is in the middle. So they take the top one and the bottom one as outliers, and they just pick the one in the middle. So this sounds pretty fair. Then the second thing is, when you were married, how do they actually calculate your credit score? Before I had researched this, I had really thought that they would take your 2 scores and kind of average it out. Unfortunately, that's not the case. What they actually do is they take whoever has the lower credit score, and that is the credit score that they use. So it seems like in some cases you would not want to use your spouse when applying for the loan. However, in these 9 states, for example, you have to include both people on the mortgage loan. So if you are in Arizona, California, Idaho, Louisiana, Nevada, New Mexico, Texas, Washington, or Wisconsin, this would not be an option for you, and you just simply have to deal with whoever has the lower credit score. Another downside to taking your spouse off of the mortgage would be if you need their income to justify the loan, then you can't do that. The person with the higher credit score would also need to make enough money to get the loan by themselves. And if the person with bad credit has a lot of cash stashed away somewhere in one of their own bank accounts, you can't count that as one of your assets either. So for some people, unfortunately, they just simply can't qualify for a mortgage by themselves without their spouse, even if it does make the interest rate go up. However, if it is an option, I would highly consider it. So in recap, the interest rates on home loans are really crazy right now, and it is costing people a lot more money than it used to. If you bought a $250,000 house at the beginning of this year, you would pay the same amount per month as a $200,000 house today. And when it comes to getting a loan, the mortgage company looks at both you and your spouse and picks the lower one to choose the rate for. However, in most states, it is an option to simply leave your partner off the mortgage and just get the mortgage by yourself if you can't afford it, and if you are the one with the higher credit score to get a better interest rate. So now it's time for everybody's favorite part of the video, the joke of the day. Joke of the day, joke of the day, boop boop, joke of the day. What is a zombie's least favorite part of the house? The living room. So thanks for watching my video. If you enjoyed it, please consider subscribing to my channel for more videos, and you can join the very exclusive fan club of only 76 members as of today. If you like the video, leave a like, and if you have a comment about the video or any idea for future videos, please leave it in the comment section below. Bye.